Welcome back to Talk Tickers. You know the drill. This is the show for experienced investors. We strip away the fluff, we get straight to the numbers.
Straight to what matters?
Exactly.
Yeah.
And today, we are sharpening our focus on a really interesting one, GE HealthCare. We're breaking down their Q4 2025 earnings call.
And let me tell you, this was not a quiet quarter. Not at all. If you just, glanced at the headlines, you might have missed the real story here.
I think you would have. And let's set the scene with the market reaction, because that tells you everything you need to know about investor psychology right now.
Right.
So you had this really noisy margin compression, and we'll get into that. But despite that, the stock, it popped about 4.9%, closed around 82.63.
Yeah.
The market basically saw some ugly backward-looking costs and just said, we don't care. They like the forward-looking story that much more.
It's a classic case of the street buying the visibility story. This wasn't just a simple beat. This was a demonstration of what we call self-help in a really tricky macro environment.
Self-help, I like that.
Yeah, because usually when a company reports a huge margin hit from tariffs, you expect investors to, run for the hills.
Of course.
But here they saw a management team that's not just waiting for the weather to change, they're actually adjusting the sails.
Okay, so here's the agenda for this deep dive. We're going to hit the headline numbers, the what. Then we'll dissect that whole tariff situation and this heartbeat operational system they kept bringing up.
The how?
The how. And we need to spend some real time on the tech, specifically Flurcato and the Intel deal, because I think the market might be underestimating the product shift.
Big time.
And finally, we'll look at the 2026 guidance that got everyone so excited before we finish with our signature not financial advice segment.
Let's do it. Let's get into the numbers.
All right, results snapshot. So headline financials. Revenue came in at $5.7 billion.
Which was a beat, a solid beat by about 1.9%.
And organic growth clocked in at 4.8%. Now, in this environment, almost 5% organic growth for a company this size, is that actually good or is that just inflation?
No, in this environment, that is very solid. I mean, you have to remember, this isn't some software startup.
Right.
We're talking heavy equipment services, hitting nearly 5% organic when hospital capital budgets are, let's say, under scrutiny. That's impressive. It shows they have pricing power, yes, but also real volume growth.
Okay, so the top line's healthy. Bottom line, adjusted EPS hit $1.44.
And that just squeaked out a beat by a penny against consensus.
So top and bottom line beat. Sounds pretty good, right?
Well, hold on. This is where we have to, peel back the onion a little bit.
Here we go.
The growth is real, but if you look under the hood, the margins, they took a significant hit. Adjusted EBIT margin was 16.7%.
That's down 200 basis points year over year.
200 basis points.
Right.
For a mature industrial company like this to lose that much margin in a single year, I mean, that is usually a huge red flag.
A disaster signal. But we know the culprit. They didn't try to hide it.
No, not at all. They called it out explicitly. It was tariffs.
Right.
Specifically roughly $100 million expense headwind in the quarter.
It's just in the quarter. Let's just pause on that number. $100 million in 90 days. Just gone, evaporating from the profit line.
It's a massive chunk of change. And it really speaks to the exposure they have to cross-border trade, especially with China.
But here's the nuance, right?
This is the key. Despite that $100 million hit, they still beat EPS expectations. And that tells you the underlying core business is performing exceptionally well to absorb a blow like that.
It's like running a marathon with a weighted vest on and still winning. Okay, let's talk about the safety net. The number, I think, kept the floor under the stock price, the backlog.
This is the number that matters for anyone holding this long term.
A record backlog of $21.8 billion. That is up $2 billion year over year.
And their book-to-bill is healthy, too, 1.06x.
So why is this the key sentiment driver?
Well, look, if you're an institutional investor and you see a backlog of almost $22 billion, what you're really seeing is an insurance policy. It means they have revenue visibility that insulates them from short-term shocks. If the economy gets wobbly or if hospitals freeze CapEx for a quarter, GE HealthCare still has $21.8 billion worth of orders to fill.
And that gives the street a lot of comfort. Plus, cash flow was solid, $916 million for the quarter.
Yep. Cash is flowing, orders are stacking up.
But having the orders is one thing. Actually building and shipping the machine to recognize the revenue is another. Which brings us to this heartbeat business system.
I know your eyes usually glaze over when companies start talking about their business systems.
They do. It usually sounds like corporate buzzword, bingo,
Yeah.
Synergy, holistic, all that.
Right.
But they frame this as the steady pulse driving discipline. And they gave one stat that really caught my eye. They cited a roughly 25% average monthly improvement in past due backlog compared to the prior year.
See, that's where the rubber meets the road. I want to explain why that specific stat is so critical.
Please do.
This isn't just about people working harder. The heartbeat system, and they use that SQDCI acronym, Safety, Quality, Delivery, Cost, Innovation. It's about decision velocity.
Okay, break that down. What does decision velocity actually look like on a factory floor?
So imagine a factory floor making CT scanners in Wisconsin. In a traditional setup, if a chip is missing, the line stops. Maybe a manager sends an email. A decision might take 2 days.
Okay.
In the heartbeat system, there's a tiered escalation. If a part is missing at 8 a.m., it's on the plant manager's desk by 10 a.m. If they can't solve it, it hits the regional supply chain VP by noon.
So they're forcing the problem to the surface immediately. No hiding.
Exactly. Reducing past due backlog means they are getting inventory unstuck. Machines that were 90% finished are now 100% finished and shipping. That converts inventory into cash.
The difference between a contract collecting dust and cash in the bank.
And in this world, with tight supply chains and tariffs eating your margins, velocity is the only defense you have. You have to turn your capital faster.
Okay, so let's tackle the tariffs head on again. That $100 million hit in Q4, painful. The big question was, how are you fixing this for 2026?
Right? Are you just going to eat that cost forever?
And the answer was no.
No. And this is that self-help narrative. They aren't just raising prices and hoping for the best. They are physically moving manufacturing lines. Specifically, they moved a PCT line and a surgery line to the U.S.
They brought them onshore.
Correct. And they're leveraging partner networks to source from different geographies, places that aren't subject to those tariffs.
I have to play devil's advocate. Moving a factory isn't like moving a couch. You don't just put a CT scanner assembly line in a truck.
No, you don't.
We're talking FDA-regulated medical devices. Validation, testing. How did they do this so fast?
That is the right question. And the fact that they did it implies they saw this coming a long, long time ago.
Right.
You can't move a PT2 line in 3 months. They likely started this 18 months ago, anticipating that trade tensions were not a short-term problem. This is supply chain resilience in action.
So they're engineering their way out of the tariff track.
Precisely. And their guidance suggests that the tariff impact in 2026 will be less than it was in 2025 because of these moves. It's a huge logistical chess move.
All right, let's pivot to the fun stuff. The tech, the new products. The spotlight on the call was definitely on Flurcato.
Flurcato.
Flurcato, it's sticking with Flurcato. So what actually is this thing?
It's way more significant than just a new contrast dye. It's a PET myocardial perfusion imaging agent.
Okay.
Basically, it's a radioactive tracer used to diagnose coronary artery disease. But here's the technical kicker. It uses fluorine-18.
And why does fluorine-18 matter to a hospital CFO?
Because most current tracers have really short half-lives. You have to make them right next to the patient.
Okay.
Fluorine-18 has a longer half-life, about 110 minutes. That means GE can make it in a central location and ship it out. It just makes the logistics so much easier.
So better images, easier logistics, sounds like a winner. But they mentioned a go slow to go fast strategy.
Which is code for we're having production issues, right?
Usually.
But in nuclear medicine, go slow is actually a good thing. You're dealing with radioactive isotopes. You cannot mess up quality control.
Fair point.
And they dropped a key stat. In the week ending Jan 23, they delivered 220 doses, with on-time delivery hitting about 95%.
220 doses. Doesn't sound like a lot.
It's the ramp that matters. They're proving the distribution network works. And you have to remember, this is a high-margin consumable. It's the old ink for the printer model.
Right. Sell the PE scanner once, but sell Flurcato every single day.
Exactly. And speaking of the scanner, we have to mention the Omni Total Body PT and the Photon Counting CT.
Photon counting CT. I keep hearing this is the next big thing in radiology. Why?
Think of it like the jump from an old tube TV to a 4K OLED.
Okay.
Traditional CT scanners use a two-step process to see X-rays, and you lose information. Photon counting measures each individual X-ray photon directly. It is incredibly efficient.
So sharper images with less radiation.
Significantly less radiation and much, much higher resolution. You can see tiny blood vessels you simply couldn't see before.
And that lets them charge a premium.
It drives that mix shift we always talk about. They're shifting revenue toward these higher profitability technologies. Their 3-year vitality rate revenue from new products is now 55%.
55%, up 5% year over year. That seems wildly high for an industrial company.
It's huge. It proves their R&D is paying off. More than half their revenue comes from tech launched in just the last few years.
Speaking of new things, let's talk about the future, the Intel acquisition.
Right. Expected to close in the first half of 2026.
The financials they gave were about $270 million in revenue in the first full year, low double-digit growth. But why does GE need Intel? Can't they just hire a bunch of software guys?
It's not just software, it's edge computing architecture. Intel has specialized hardware and software designed to process huge amounts of imaging data at the edge.
Meaning right on the scanner itself.
Exactly, not in a server room down the hall. If you're running an AI algorithm to detect a stroke in real time, you cannot afford latency. You need that processing power right there.
So they're buying the brain for their machines.
And that brain comes with a really nice recurring revenue tail. Subscriptions for AI upgrades, cloud management. Wall Street pays a much higher multiple for that than for hardware.
Okay, let's unpack all this and see what it means for the numbers, the guidance. This is what fueled the stock rally. Let's break down the 2026 outlook.
Let's do it.
Organic revenue, up 3 to 4%. Adjusted EPS, $4.95 to $5.15, which implies, what, 8 to 12% growth?
A very healthy clip.
And the margins, this is the big one, 15.8 to 16.1%, expanding 50 to 80 basis points.
The margin expansion is the critical takeaway. Remember, they just took a 200 basis point hit, and now they're turning around and telling the market, we're going to expand margins next year.
That feels ambitious. Are they being too optimistic here?
I don't think so, and here's why. The China factor. The CFO, Jay Sakaro, he was very explicit. He said they are, quote, anticipating a decline in China in 2026.
That is a bold thing to put in your guidance. Usually you hear, oh, China is challenging, or something vague. He just said, nope, we expect it to go down.
It's incredibly prudent. It's what we call kitchen sinking the expectations. They're not banking on a China recovery to hit these numbers.
So if China recovers?
That's pure upside. The base case assumes it gets worse. That gives the guidance a ton of credibility. It's built on the heartbeat efficiencies, not on hope.
They did warn about Q1, though. They said Q1 will see the largest tariff impact with organic growth of only 2 to 3%.
Right, there's a timing mismatch. The tariffs are hitting now, but the factory moves take a few months to fully kick in, so Q1 is going to be messy.
But the market seems willing to look right past that.
Yes. Because the investor takeaway is that the trough is in Q1. If you believe the mitigation story, the trajectory for the rest of the year is up. The setup is visibility plus execution.
It feels like they've earned the benefit of the doubt. The backlog is the floor, the execution is the ceiling.
Exactly. Management is in control of the ship, even with rough seas.
So we have a company navigating trade wars, pivoting to higher margins with some really cool tech. Which brings us to my favorite part of the show.
Oh boy, here we go.
The This Is Not Financial Advice segment.
And the disclaimer, we are just two voices in your headphones. This is for entertainment. Do not trade based on this. We are not your advisors.
Exactly. But if you are pitching a wild but plausible trade idea after this call, what is it? I'm calling this one the onshore alpha squeeze.
The onshore alpha squeeze. Okay, I'm listening. Lay it on me.
Here's the setup. The market thinks medtech is dead money because of tariffs. Everyone's scared of shipping costs.
Yeah.
But we just heard GE HealthCare is physically moving production to the U.S. They're decoupling from the ocean.
Okay, localizing production. Got it.
Right. So the trade is this.
Yeah.
You go long GE HealthCare calls to capture that upside. But, and here's the twist, you pair it with a short on a basket of pure-play logistics companies that rely on trans-Pacific medical device volume.
So you're shorting the boat.
I am shorting the boat. The logic is, as GE HealthCare localizes, they decouple from shipping volatility. You capture their margin expansion while betting against the shipping volume that used to move those scanners. It's a deglobalization pair trade.
That is creative. Let me push back, though. Do shipping companies have enough exposure to just medical devices to really move the needle on a short? They move everything.
That's the risk, right? You'd have to find a specialized carrier. But think about the margin on those shipments. Shipping a massive MRI magnet isn't like shipping sneakers. It's specialized, high-margin work. Losing that business hurts.
That's a fair point. The high-value, white-glove logistics work dries up because the factory is now in Wisconsin, not Beijing. That hurts their margins.
Exactly. It's a bet on the heartbeat working. If it works, the ships carry cheaper stuff, and GEHC's margins go up.
It assumes a lot about the speed of those moves,
Yeah.
but the logic holds up as a thematic trade. It's a bet on deglobalization.
That's all I need.
Yeah.
All right, let's bring it home. Conclusion time.
So to recap, GE HealthCare delivered a beat and raise quarter. It was disguised by a lot of tariff noise, but the signal was clear. The $21.8 billion backlog provides the floor. That's your downside protection.
And the margin mitigation moving factories, the heartbeat stuff that provides the ceiling lift.
It's a floor in a sailing story. And my final thought for you to mull over is this. Watch the Flurcato ramp and watch China. They guided China down. But just think, what if China just stabilizes? What if it just stays flat instead of dropping?
Then that guidance becomes very conservative very quickly.
And suddenly that 3 to 4% growth looks like 5 or 6%. That's where the surprise upside lives for the rest of 2026.
Well, there you have it, a complex quarter distilled into a clear path forward. Tariffs are the villain, execution is the hero, and the backlog is the fortress. As always, thank you for listening to Talk Tickers. Remember to do your own due diligence. Talk Tickers out.